Hey, Stink, you got 10 minutes for a free financial literacy class? Let's go. Well, welcome back, class, to another wonderful video on financial literacy. And today we're talking about the stock exchange. With all of this bank bailout business in the news, let's talk about the stock exchange. And this is being presented by Black Girl Magic Masters, LLC. You already know, we're trying to say this whole motherfunking universe one person at a time if we have to, because we're on a mission. Yes, a mission to restore our community financially. And as a mobile and virtual minority business center, we're going to do it. So let's get into it. All right, so, and I'm your lovely Professor Dr. Keela, and so I need you to remember from past videos on stocks and mutual funds that a stock is a form of security that indicates that the holder has a proportionate ownership in the issuing corporation and is sold predominantly on stock exchanges. You also know it as a share, right? Shares. See, corporations and businesses issue stock to raise funds to operate their businesses. When a bank is needing... Anyway, let's move right along. There are two main types of stock. There's common stock and preferred stock. So, the stock exchange, well, how does a stock exchange make money? See, the stock exchange, it allows investors and traders to make money by providing them with a marketplace for trading their their securities. They also allow companies to raise money by listing different kinds of securities on this exchange. You feel what I'm saying? Because exchanges, they collect transaction fees from the market participants in the companies in exchange for providing such services. So that's what the stock market is supposed to be doing. Now, who actually controls these stock prices? Well, once a company actually goes public and its shares actually start trading on a stock exchange, remember, you got to go back and look at my past videos so you can understand what that means, that its share price is determined by supply and demand in the market. So if there's a high demand for its share, the price is going to be high, or the prices will increase, as they say it to confuse you in the financial language of it all. But anyway, so remember, the stock exchange provides a ready and continuous market for the purchase and sale of securities. It facilitates evaluation of those said securities. It encourages capital formation. Basically, when you go from an LLC to an S corporation, also known as a small corporation. Thank you, Congress, for that. But stock exchanges provide safety and security in dealings. But the main feature of these stock exchanges is basically to regulate trade in securities. Okay? Because the stock exchange does not sell and buy bonds on its own account. Now, their broker or exchange members, they can do the trade on the company's behalf. But like I said, the exchange does not sell and buy bonds on its own stock exchange. No buying and selling bonds on the stock exchange. All right. Now, some cool features of the stock exchange is that it does determine the price of securities by the force of demand and supply. I love that. You know what I'm saying? But it ensures that the safety of transactions as transactions are carried out within an existing legal framework is that's really why we like this stock exchange. It actually contributes to the economic growth. And it indirectly, like I said, promotes capital formation, and it spreads the equity around, ensuring wider shares of ownership, and that's according to donut.com. Now, but again, the most important feature of the stock market is that it facilitates safe transactions. You'll be able to really discover the price of the security for real. And that, like I said, it's just a good driver of economic growth, because it really encourages domestic citizens, civilians just like me and you, to invest our savings, into the stock market. but it also attracts those foreign investments as well, according to Wealth Desk. Okay, now moving right along. Stock classification. Stocks are commonly classified based on various parameters, most notably based on ownership rules, market cap, dividend payments, the fundamentals of risk, and basically price trends, right? Okay, so yeah, that's how we classify these stocks. Because if it's risky, huh, anyway, and like, I don't know if they I don't know if I'm going out on a limb here, but I believe that intrinsic value matters a lot. And Bitcoin currently doesn't have that intrinsic value. So, anyway, moving right along. Now, what is the SIBO? Okay, it's Global Markets Incorporated, right? It's the global exchange, right? And it was founded in 1973, but it's headquartered in Chicago. Basically, investors often turn to the SIBO to buy and sell both derivatives and equities, right? So, the SIBO is currently one of the largest U.S. Equity market operators on any given day. You know what I'm saying? Operating about 4 different U.S. equities and exchanges. But anyway, moving right along. The Bulls, the Bears, the Hawks, and the Doves. If you're like me and you've ever heard them say anything about bear markets and bull markets and hawkishness and dovishness, this is for you. So a bear market occurs when stock prices fall 20% or more for a sustained period of time. Bear markets often occur in periods of economic slowdown and there's higher unemployment. A lot of people aren't working. And basically the investors, they want to sell, and they're basically often fleeing for safety of cash or some kind of fixed income security, which results in a seller's market, right? And then you have bull markets. Bull markets occur when investment prices are on the rise for a sustained period of time. Basically, confidence is soaring and the investors are basically eager to buy and hold on to securities, thus creating a buyer's market. Now, a hawkish monetary policy means that the interest rates will be higher. So investors will move their funds from other countries to earn higher interest rates. So when a country adopts a hawkish stance, demand for currency will rise and appreciate. A dovish monetary policy means that interest rates will be lower. So investors will move their funds to other countries to earn higher interest rates. So when a country adopts a dovish stance, demand for currency will fall and depreciate, losing its value, right? Share buybacks. Public companies use share buybacks basically to return profits back to their investors. So when a company buys back its own stock, it's reducing the number of shares outstanding and increasing the value of the remaining shares, which can be a good thing for the shareholder. But okay, now in most companies, returning capital to shareholders, either in the form of buybacks or dividends, it's a good thing. They used to return, they used to give you like gum and stuff, like, anyway. And in many ways, buybacks have some significant advantages over paying dividends, especially if the stock is truly trading for less than its intrinsic value. Here goes that intrinsic value again. But anyway, a buyback will increase share prices. And stocks trade in part based on supply and demand. So, and a reduction in the number of any outstanding shares often precipitates a price increase. You know what I'm saying? Companies tend to repurchase shares when they have cash on hand and the stock market is on an upswing. But there is risk, however. Oh, shit, y'all. We're going to have a part 2 because there is a risk that the stock price could fall after a buyback. And spending cash on shares can reduce the amount of cash on hand for other investments or any emergency situations like what we got going on right now with this. Okay. Anyway, y'all, listen, class, you've been wonderful. We're going to have to continue this on in the next video, part 2. You've been sitting here for 9 minutes and 57 seconds. Yay!